Excited to be here today for the TokenizeThis conference. I went to the conference in Miami. Great job by the organizers. My name is Alexis Johnson. I am the co-founder and CEO of Lightnode Ventures. This panel is going to do a deeper dive on tackling the liquidity problem in tokenization. So Alexis Johnson from Lightnode Ventures. We're a venture studio growth advisory firm focusing on a bunch of different verticals in the space, such as decentralized AI, DePIN, real-world assets, etc. I'll give it to the panelists to then do a quick intro and tell us a little bit more about what you guys are working on.
First. Brian Anderson, CEO and founder of Raze. We're an end-to-end tokenization solution for RWA issuers. So we effectively have a white glove service, and we're building a platform, a no-code platform for issuers to come on chain. We're working with everyday companies, CEOs, and in the future, fund managers that want to truly actually bring their assets on chain and help them find the best chain and the best solution to actually provide liquidity and a buy-side support for their offering.
Hey guys, good morning everyone. My name is Prasanth Kalangi. I'm founder and CEO of a company called Zoniqx. We used to be called as Assets, tokenization of assets, before rebranding happened a year ago. We're based in Silicon Valley, California. We've been doing this since 2017. So we're essentially an app infrastructure and the entire tokenized lifecycle management infrastructure for RWAs. We have done quite a few projects in this space, ranging from commercial real estate to debt funds to private equity and private credit. We are in US, Germany, and UAE markets. So we have also built a couple of protocols in the space, and happy to talk further on this panel. Glad to be here.
Hello, everyone. I'm Rob Durscki from Stellar, the layer one. My title is a long one, but making it short, I take care of the partnerships for regulated assets, so sometimes referred as institutional partnerships. And just to give you guys kind of an overview, there's like 3 big pillars on Stellar. One is the payment aid side, which is kind of our bread and butter for the past 11 years. Then a newer big vertical, which is the DeFi and TVL. And the third one is regulated assets. And that's what me and my team take care of, partnerships on the Stellar side. Happy to be here.
Hi, John Lenahan from Digital Investment Securities. We're a partner firm of 21X. We provide end-to-end solutions for issuers and asset allocators to enter the digital securities business. 21X is our partner in the first regulated trading and settlement platform in Europe. So we facilitate trading across money markets, securities, bonds, et cetera, as well as real-world assets on the primary side.
Awesome. So for our first question, how would each of you define the core liquidity challenges facing real-world assets today, and how does tokenization provide a potential solution?
I'll start. I think it starts with primary issuance. I think liquidity, well, in crypto, we've seen exit liquidity as the challenge, of course. And so we're really focused on primary issuance, revenue-based liquidity, yield-bearing liquidity, things that actually benefit investors. So if you're doing a primary issuance and for all intents and purposes the deal's terrible, you're not going to take a bad deal and make it better because you're bringing it on chain. So we're looking at the kind of end in mind first, which is who's going to buy this stuff, right? And I think that's really the biggest challenge that we've dealt with, is that people keep talking about liquidity, like it's going to be some sort of airdrop or something that occurs because you bring it on chain. It's not the case. You have to actually design an offering that people want to buy. And if you do that, then we know all the other buzzwords in this space that we can chime off and talk about how all of a sudden it's actually going to make it a better solution. We have a kind of funny saying that one of our team members coined, which is tokenized securities or tokenized offerings are basically taking roller skates and putting it on a security. But ultimately, at the end of the day, it doesn't change the underlying security itself.
Yeah, my take on that is, I think I agree with some of the points Brian said, right? I mean, a garbage instrument, tokenized, untokenized, still is a garbage instrument, right? So people really need real asset that has got like properties from a long-term investment point of view. And if the issuers that come and then try to think that it's a North Star, that I put something on chain, helps me to sell that, it doesn't really happen. That's one piece of it. Let's say that you've got a really good asset. So we started with flipping homes with a 50 million portfolio. We are the first ones to mint on Polygon in 2021. That didn't sell well, and then for various reasons, and no one bought the token. And then eventually the issuer has to give up this dream of tokenizing assets. But we, being a deep tech infrastructure, we kept on that going even till today. So in commercial real estate, if you have like an yield-bearing or a fixed income product, right? When you tokenize it, there are people who want to buy it. There are people who want to really look into it deeply. But how do they discover this asset? There is no discoverability of asset that's happening today. I mean, the spectrum is so big. You've got extreme illiquid assets in one hand in nature. That's how they are. An extreme liquid side, right? So people have been experimenting on treasury bills. The T-bills are good. They're selling like great, the tokenized for T-bills outside US because they want access to the T-bills, which they don't get at all. And the tokenization of T-bills gave them that access. And money market funds is going good because that's intrinsically semi-liquid and liquid in nature. But if you take somewhere in Alaska, a mine that's there, fully liquid in nature, try to tokenize it and put it on chain and XPV structure, people need to know about it. People know about the risk analysis of it, the underwriting of it, the price of it. There's a lot of components that are required to go with that token. And then that is where the gap in the industry is, which we believe. And Zoniqx is solving that, is trying to solve that, which I'll talk a little bit later. I think that's my take on it.
I'm just curious if we have two mics, it's a stereo. Oh no, there you go. We're supposed to use this one. Yeah, I'll kind of just heat it up a little bit in the sense that I don't think we have a liquidity problem. I think we have a product problem. Liquidity is just a consequence. And back to Brian's point, I have the privilege of working with like very smart and big institutions in this space. Some of them are here. I can't tell which exactly, but just naming a few: Franklin Templeton, Wisdom Tree, Ondo, Red Swan, they're all issuing on Stellar. And what I observe on those which I think are the pioneers and kind of the ones making this happen is that they're thinking about making a good product, and then liquidity will come. So just to kind of kick off this conversation, I think the first point is that tokenization doesn't bring liquidity. I think a lot of people is writing about that on LinkedIn, Twitter, whatever. It might be a punchy sentence, but it's not true. Like, tokenization is just a feature of the product that on its own doesn't make the product necessarily better than any existing product. I think the idea is to use blockchain as another technology, just like internet and mobile was a couple of years ago, or maybe cloud, and create a better product to the end user, being it a retail investment product or a wholesale investment product. So I think we're going to talk later today about the collateralization of money market funds and other products on chain, and that allowing to unlock T+1 in the US, T+2 in Europe. So I could go on and on, but I think the focus is we should build products that are better inherently, period. And then liquidity will come. Of course, you got to have breathing room and runway to build and launch that product and not run out of cash in a week, because then liquidity will never be able to catch up. But I think that's an important mindset shift, right? Like, can this technology enable you to build better products to either existing or new consumers? And then liquidity will come. Like, the money will go towards your product if it's a better product.
So I would agree with that. I think everybody in this room has had the same experience. You get ushered into a beautiful conference room, and before you have time to put cream in your coffee, you get in your question, how do I get liquidity in my assets? And it's the holy grail, right? You know, ultimately, you know, I think technology can provide liquidity, it's regulatory now. It's now information. It's how investment managers or investors can make decisions and informed decisions on illiquid assets or even liquid assets in a timely fashion. And the technology will facilitate that trade. We have that ability at 21X now. I think that the actionable items that exist, I would agree with Brian on this, it's around the primary side for real world assets, and then obviously the tradable securities. So I think it's going to come. It's the regulatory side, it's the authorities, it's the accounting, the auditable information, so people can make informed decisions about putting capital at risk. And the technology will facilitate that trade. I think we're closer to that than people realize, and it may happen in other jurisdictions beyond the U.S. initially.
Got it. And so my next question is, what specific asset classes have shown the most promise for tokenization in terms of addressing the liquidity constraints? Is it real estate, art, private equity?
Well, I'll be a little biased here because one of the reasons we came here is we were announcing one of our first RWA projects this year, which is around essentially private lending, private credit. And I think that is really a great asset class. But I think this kind of story tells you a little bit about where we see our bias go towards, which is you've got I think he's had his company for 20 years now, Ferox Holdings, and they smelt different metals, titanium, iron, et cetera. And they've gotten their financing from traditional sources for many, many years. So they wanted to explore tokenization, and it took really a lot of time to structure it properly to where it would just make sense for people that would want to buy a token that backed this. So a yield-bearing token where somebody could come along, purchase the token, hold it for a period of time, then the redemption period expires and they get their principal and their yield back, is a great solution because the investor has their liquidity, they get some sort of yield, and now he gets enough money to be able to go do more production financing, and he's never dealt with a bank, he's never dealt with a private investor. It has eliminated significant cost structures. The time to market was 90 days or less. And it really, and here's the key, it's now opened up not just to a Reg D offering in the United States, but also around the world to potential token purchasers that are non-accredited. Now he's just opened up a global market for being able to borrow money. So to me, those kind of use cases are the future, at least over the next couple of years, or what's going to drive this industry.
I mean, I can also speak about the assets that Zoniqx has tokenized and the issuances that we see that are in demand. I mean, as I stated earlier, we started with the single-family home flipping 50 million that didn't go well. So since then, we have seen like significant amount of like tokenized real estate that came, which has got some yield to it, and then some of them have been taken well by the investors. But currently, we are seeing a lot of demand in three things. The first thing that we are seeing demand is private credit, private equity, and also we are seeing demand in some of the, I would say, yield-bearing instruments, could be real estates, but those are specifics to local markets and local jurisdictions. These are three things. And we work with asset managers, we work with private credit, private lending guys as a specific use case. On the private equity side, so we have announced $1 billion tokenization for a data center, green AI data center, and the data center is going to come, physical data center is going to come in Niagara Falls here, and then it's going to be announced. We announced publicly on XRPL with an RM private equity fund. It's a public news. And that has got a huge demand we are seeing because the energy suppliers are green and there's hyperscalers are already renting out for 20-year lease. Contracts are in place. So that's an asset class which we see. And then the other one is a reinsurance tokenization. So you take a reinsurance contract on insurance and then you tokenize the contract and the returns are good, phenomenal, as the issuer promises, because we don't promise anything, we don't do anything because we are a non-licensed entity. That's a demand that we are seeing. And the third one, I would say, is the a trade in the trade finance, the private credit. In the Asia market, we are seeing the demand on that side as well. So these are specific things which Zoniqx is doing. And the total volume of these issuance are about like $4 billion in total that we're issuing for on behalf of the issuers.
I'll kind of follow Prasanth's thought process here of just sharing data of what we're getting as inbounds from partners. So as a layer one, we want to be agnostic, not picking winners, and ultimately just building the infrastructure that would help regulated institutions to build and grow their products. That said, obviously, some topics are coming more frequently than others. So I just took some notes here. The ones that I think we got multiple inbounds, both live and about to go live. Number one, almost by far, is money market funds, and not only in the US. So a lot of demand for that. I think initially dollar-based, but we're growing to other sovereign debts as well, and not only in the EU region, but also in emerging countries like Mexico and Brazil that has dollar-denominated debt at a higher interest rate. Second one is index funds, and WisdomTree is doing a great job on that, offering a few of those on-chain with instant settlement and daily yield. That might be the next frontier. I think there's a debate how convenient it already is to buy index funds on non-tokenized fashion, so back to my product point. Real estate, I think there's a lot of excitement on that product. I'm not an expert. Edward from Raze is here, so he's the guy to go to. But we've seen a lot of inbound and also like reports, like I think the latest from BCG, putting real estate as either number one or two for the 2030 roadmap. Gold is a personal project that I want to kind of give better retail access to, because I think in situations like now where we have a lot of political volatility, you just see that institutional investors immediately run to gold, but then what are the retail investors left with, right? Like a bank savings account at a 0.5% a year. So I think that's still something to break through. And the last two, which I think are more in the, well, I wouldn't say aspirational, because I think private credit already have huge numbers, but the last two I have here is private credit and just stocks, which is also something that we tried maybe too early in this game to tokenize stocks, US stocks in the European market before MiC and all this regulation came about, and there was some traction, but we didn't get quite there. Maybe my last note is that those 6 data points come mostly from the sell side, right? And we need to kind of sort out what the buy side is going to be, because I think that's what's going to dictate sustainability here. So I think this is where the issuers are exploring. It's still unclear, and I wish I knew what the customers are willing to buy on a tokenized fashion. And once we connect those dots, then I think we sorted that puzzle for the time being.
Yeah, so if we're talking about immediacy of opportunity, I would bifurcate it into 2 areas. I would agree with the panel that alternative assets, there's the greatest utility and value to driving liquidity across the asset classes that have been mentioned here: infrastructure, real estate, private credit, private equity, et cetera, et cetera. So on one side, that's a huge opportunity that's going to have a journey here, I would say, over the next 18 months. It'd be quite meaningful on a global basis. The other, on the tradable side, where there is a high degree of liquidity already, it's really about providing a different access point to new markets, new investors, in a way that they want to trade and the way that they want to interact on a global basis. And that's opening up beyond the US borders here, quite dramatically, and into new investors that want to stay within the crypto Bitcoin wallet space. So I would say if we're looking at immediacy of opportunity, that's the 2 areas I'd bifurcate into.
Got it. And my next question is, how do you balance the trade-off of increased liquidity and potential price volatility that comes with tokenization?
Sure, I can jump in on that one, put my CPA hat back on. But it's really about managing risk, right, and managing information. You're going to get volatilities in markets. The triggers can sometimes be unknown, as we just found out with tariffs. But they've always existed, right? There's always been a growth phase. There's always been a recession phase, et cetera. And what's always the linchpin of investments that get in trouble, or people get in trouble, is not having transparency of information, accurate information, highly reliable information in a way that can be disseminated appropriately. So managing risk and managing volatility and opportunity within that and finding investment opportunities really requires transparency of information. And I think that's one of the gating issues that regulators really have to address immediately to really begin to unlock capital and create a velocity capital that can really grow a number of businesses and economies across the world.
So Alex, just want to clarify, the assumption on the question is that tokenization can lead to more volatility? Was that the assumption?
Yeah. So for like traditionally illiquid assets like real estate, there's not as much volatility as opposed to now bringing those assets on chain and potential price volatility that comes with that.
Yeah, I would just add that I think volatility could be a good and a bad thing depending on the reason of volatility, right? If you have inherently volatile assets that have liquidity and they're just reacting to their alpha or behavior, that's good. If you have volatility because there's a lot of slippage and lack of liquidity, then I think that's bad. So in that sense, I think on a regulated sense only, because I think Nick from Solana is here and they're doing a great job on assets that are inherently volatile because they're unregulated and more retail focused. On the regulated side, I think we're not there yet, where the private equity hedge funds would potentially come on chain, and then the volatility will be a good sign because there is activity, right? At this point, actually, you would see volatile assets with low volatility, although that's contradictory because there's no liquidity, so there's no action. The order book is stuck, right? So, yeah, I hope we get there where it's proportional volatility to the asset class.
I agree. I think from managing this, so there's so in Zoniqx, in the tech world, we call smart contract locks, right? So you have to see the redemption periods, you have to see the hold periods, and you have to also create a permissioned way for gated KYCs, right, to manage this. And then to your point, you have to have a price oracles also, which you have to create Chainlink. We integrate with Chainlink that has got a component that provides this pricing for even non-liquid assets by nature, as you said. So all this stuff will have the control gates mechanisms to prevent this from having this hyper volatility in the places where there is something that's phony thing is going on. So that's how I think we should control the trade versus volatility percentage.
Yes, and my next question is, tokenized securities face several liquidity challenges from the buy side perspective. How can the industry address these challenges over time, especially as it pertains to the buy side?
I would say the first, this is, I think, if you see, I think I started my career with supply chain management, ERP systems back in the day, where you have this electronic data interchanges, EDI standards for every drop shipment, every AR, account receivables, payables. You've got a standard that says, okay, 835, 834, so we know, okay, EDI 835 means, okay, it's a shipment node is supply chain. In banking also, we have got SWIFT standards, right, in banking rails. In tokenization, unfortunately, there is no standardization or a standard that's accepted widely, so there are standards. So I believe that once you have this achieved, right, the interoperability in a standardized manner, there is a big way for this to have the buy side discoverability and the buy side to be, okay, everyone talks the same language, they understand, okay, there's this certain amount of risk analysis has been done on this token, certain amount of information is carried by this, the legal, the regulatory, the structuring, everything is done to a standard way. It doesn't need to be publicly displayed on public chain or private chain, I'm not getting there, or hybrid. But the standards are very critical components, which I see is missing. So we have launched a standard called ERC 7518. It's an open source protocol. We have done this from the last 5-6 years of our experience. There is ERC 7518, there is ERC 1400, there is ERC 3643. So these are all standards trying to do the same thing what I just stated. That is only for EVM-based chains. There is non-EVM chains like Stellar natively, Ripple, other chains, Solana. They're creating their own standards, right? But there is no uniformity in this. I believe the regulatory authorities, they will start looking at this very closely. They want to see how can we standardize this in a manner that it's widely accepted by the industry. I think that is one part. The other part is the cross-chain interoperability, which I just mentioned. So we have got a protocol called DICEST that can talk between EVM and non-EVM chain. So basically, you've got a payment method on one chain, an issuance on another chain. Then how do you do these things, right? Very seamlessly. People have been experimenting it, but we have got a real valid working product that's out there. So I think these are the two pieces I would say, because every day you got like, we're chain agnostic, asset agnostic, so they got to think very bigger and in a way that it's uniformly created on a standard line. I think standardization is the number one thing that comes to my mind.
Yeah, I would just zoom out a little bit and think that the buy side is dictated, and I'll take a retail market approach because that's where I come from, so not very comfortable talking about the success of wholesale and capital markets. But on the retail side, financial products are usually driven by one of two things. It's features and access, right? So either the product is better than competitors or it's at par but has a better channel of distribution, right? So I think here on the buy side, we might not be there on neither on blockchain, where product features are indeed growing, and I think Franklin Templeton is going to speaking later today about Benji, and we've been working with them since day one, I guess, and we saw all the way they came with the product roadmap and feature, right? It started as being a retail buy, hold, sell asset, and now it has USDC capabilities, peer-to-peer transfer, third party, and a bunch of other features. So I think the feature part, there's a lot of work to be done. Like how do on-chain products differentiate from off-chain products? Could be that maybe efficiency drives some base points, and maybe that's not what's going to drive retail adoption. But I think the second part, the access, is the one that, and maybe I should have said this earlier, but Stellar mission for 11 years now is the same, is equitable access to financial systems, right? And that sometimes it's a bit of a loaded term. So it's just like making it easier for people to have access to financial products. And one thing that most people don't realize, especially if they only lived in the US, is that I come from Brazil, and Latin America has this inherent lack of access to quality assets, right? Like more than half of the population in Brazil that has any extra wealth parks it on savings accounts on banks, which are regulated as below par of national debt. So you're just not basically competing with inflation. If you try to buy T-bills in Brazil, and I tried, so I have data points to compare to what we have with our partners in the US, you would get 3% max, and that was maybe when interest rates were even higher, and it's only for private clients of big banks. So there's an inherent big access blockage to financial products, and that's where I get excited, because I think not only tokenization per se, but things that we invest on Stellar, like non-custodial wallets, KYC through on-off-chain solutions, and making it very cheap and fast so you can pay yield daily or more than once in a day. It's something that would hopefully drive adoption of new clients, so new money, right? So that's what I think maybe the buy-side next frontier is going to be, which is expanding those products, not just making it better to the existing clients, or some people would say make the rich richer, but let's help people that don't even know those products exist, and then use the technology to make it easy for them. Because we've been seeing in Africa and Latin America how fast WhatsApp, digital banking, Nubank, Revolut, N26, how fast those technologies got adoption. TransferWise, which compete with remittance business even without using blockchain, and PayPal with eBay, and now with PYUSD. So you have tons of examples of where technology led to massive adoption of new products, but I think it has to come to that idea of like, how do I make it better than what they have today? And I can tell you, in emerging markets, especially talking about Latin America, but I know about a few in East Europe as well, there's a huge lack of access to quality assets, and hopefully this is part of the solution.
So I guess I'll give the old man historical perspective of how this could be adopted. Back in the day when ETFs were launched, we were told for years that it was just a retail product, would never be an institutional product. And you laughed at that because you looked at the benefits and the utilities that it provided as a product wrapper to the institutions. It was obviously going to be adopted, greater liquidity, access, trading, et cetera. standardization. So when I look at the advantages of tokenization, digitization on the asset side, there are a tremendous amount of benefits. The linchpin for the full success of cost savings, transaction, et cetera, is getting the infrastructure right and making the infrastructure reliable and regulated and secure. And so that combination has to occur. We're well on that journey, right? And we're starting to get these proof cases out there and established. And when those are anchored, you're going to see an explosion because the operational utility and value of the blockchain combined with the digital asset solution, it has tremendous utility across risk management, reporting, investment decision making, and efficiency of get the exposures to the assets that the buyers want. So I think there's an extra hurdle to gain this utility within tokenization, but it's going to transpire and it's going to be transformational for financial markets.
And I'll just add one more thing to what the panel's already said, is I think we forget too that there are still real barriers for onboarding traditional fiat to digital money. And I experience it almost every day, and I watch people, even if they're in these digital fintech banks that now support crypto, the amount of friction that exists of simply moving fiat money to crypto to, is it a decentralized wallet that I need? Can I keep my crypto in my fintech bank? Coinbase has locked my account. My bank doesn't authorize these. I mean, that's real stuff, right? This is real human behavior that they have to deal with. And the minute you start seeing that happen with somebody that wants to park 100, 200,000, $1 million into a digital asset offering, if they have to go through that and they get to a point where they say, this isn't even worth it. I'm not going to convert my money into this. Now you've just lost that person where even if it is a good digital product offering that they want to participate in, it's just, there's other investments that they can participate in. So that has to be solved. And I think this year, there was some other panel yesterday, I can't remember which one, they were talking about, and there was a lot of truth in this, where they said, as much as we hate to admit in this industry, meme tokens, NFTs, and some of the fun or silly things of this industry have actually onboarded trillions of dollars of liquidity that now we, as more sophisticated professional folks, want to take advantage of and tap into that liquidity, right? But where did it come from? It came from retail. It came from that kind of stuff. So that has to be solved to find big money.
And so my next question for panelists is around, trading platforms. When will we see the equivalent of, let's say, a Binance or a Coinbase when it comes to tokenized securities? John, I would love for you to chime in here, especially given your background. And what are some of the barriers and challenges for launching a successful trading platform for tokenized securities?
So yeah, great question. Probably Max at 21 asked you to ask that. So as the first regulated digital security, we were laughing about this earlier. It's everywhere plastered. It's been an 8-year journey, right? To build the technology, the platform, the compliance, integrations, the whitelist wallets, navigate through the regulatory authority, et cetera. The transactional trading side, right, is reasonably straightforward, right? That is not all that difficult, but the facilitation of the atomic settlement of getting the trading and really managing that money in a risk appropriate way, right? No foot faults within the business is quite a difficult task. The technology is there. It's evolved obviously over the last decade quite nicely, but the putting it together and having it multi-chain and open architecture to folks as opposed to a closed network, I think is very much game changing for the industry, and it's going to facilitate issuers, coming on board at a reasonable cost, and then asset allocators having that reliability of liquidity and trading authority to execute. So we're rapidly approaching the point this discussion around liquidity and how it can be transacted. And 21X has led the way there, both in terms of technology, trade, settlement, and regulatory. There will be others. We'll have competitors. We hope that the tide rises for all here, and we can all participate in it. But the technology development is quite significant and is differentiated. And I think we've seen challenges of that. Traditional exchanges trying to migrate into the digital world haven't done it successfully. So there is a competitive advantage there, I would say, within the marketplace. It's going to happen. It's going to happen broadly with multiple exchanges. So we welcome the competition when they get there. But it's the technological hurdles and the regulatory necessity and the ability to execute with certainty for investors is so critical to the confidence level of going out and talking to clients, which is what we're doing now.
And what would you say the time horizon is for the next trading platform to really take off in a big way, equivalent to, let's say, the NASDAQ for tokenized securities? The timeline.
Yeah, so our business plan is to surpass NASDAQ as soon as possible in trading. But the opportunity set is there, right? You have to provide the utility and value and differentiation, right? So I own a multi-boutique investment management firm, and the portfolio manages that trade large cap growth or value or infrastructure rate. They have liquidity, right? They like the transactions, they like the ability. So you're not differentiating there, right? It's about gaining exposures. It's about trying to find better cost opportunities for them, ways to invest across asset allocation. There was a discussion earlier in the panels today from Securitize of how they're servicing RIAs, right? The level of inefficiency and the cost at an RIA level to service a client in certain asset classes is extraordinary. So you can lower costs as you begin to create a more facilitated, easier transaction model that exists today. And that end-to-end solution to clients and having that advisor interaction and the investment management interaction can be streamlined highly effectively on these platforms that we're talking about. And 21X is kind of leading the way in that area, as others are, Securities, et cetera.
I just want to add one quick thing. The more platforms we have like this, the more marketplaces, exchanges that are digital native, that are starting with the digital in mind and being built with that infrastructure, the faster this is going to actually adopt, because trying to take a digital security that's maybe been issued by a private issuer and plug it in to an existing, ATS, broker-dealer, whatever it is, very difficult. It's possible, technically. And then vice versa, taking that digital security and thinking about how it would go on a crypto DEX doesn't make any sense, right? And so I think that's what we have to start seeing is more of these.
I think like Robinhood publicly announced that they're going to be coming into the space, right? So I think that's public. So things are definitely they're looking at, which are traditional exchanges. Robinhood is a new generation app versus like a Schwab or something else. But to your question to Binance, why they're not getting it, what they're getting, there's a lot of stuff beneath the hood that they got to figure out, right? So there's price discoveries, which we spoke, risk analysis, composability, and then like asset issuers coming into that, regulation clarity. So there's a ton of stuff they got to figure out. It's Binance is the extreme other side, and Schwab is on the extreme this side, and then Robinhood is in the middle player. And then the traditional players like RIAs, broker-dealer networks, investment managers, bankers that have got there, right? So this whole thing is going to take time, but everyone is eyeing to get to that opportunity. And then, so we have built a product that's actually connectors that connects with all these guys, right, beneath the hood, that provides and powers them. But I don't think that there is no player that's looking at it, but the new players in UAE, there's a company which we are going to partner that is going to offer tokenized products as well. They got a license for that, not just crypto, together. I think that'll be the first one, in my opinion.
Sorry, Alex, I just want to quickly not forget the elephant in the room, which is regulation, right? Like if you think about how fast meme coins and Coinbase or Binance and those, meaning those are unregulated assets, and you probably can just onboard USDT and trade all the weekend, right? And I think when we want to make securities accessible, we need to work together with regulation. So in EU, where we're spending a lot of time, MiCA, I think it's making a good groundwork for payment assets as in a regional stance, but security is still per member country, right? And in the US, we're still, I think, also waiting versus the Stable Genius Act, which is something that might help on the payment side, but I just wouldn't ignore that fact. And I think the sports betting platforms, which are getting regulated in many countries, and I forgot the second one, but anyways, I think are examples of how regulating and clarifying how those market works expedite accessibility, right? At this point, if any $100 investment in a tokenized security requires extensive KYC, investor profile, questionnaire, and it will not get there. So we should join forces, and I think this industry is already doing a good job. The new administration could go on and on, but I wouldn't pretend the regulation is not crucial for adoption, especially retail.
Awesome. Unfortunately, I believe we are out of time for this panel, but I'd like to thank panelists for sharing insights, as well as audience for listening. Thanks again, and thanks again to the organizers of TokenizeThis for putting it all together.